Welcome to Building the Future, hosted by Kevin Horick. With millions of listeners a month, Building the Future has quickly become one of the fastest rising programs, with a focus on interviewing startups, entrepreneurs, investors, CEOs, and more. The radio and TV show airs in 15 markets across the globe, including Silicon Valley. For full showtimes, past episodes, or to sponsor the show, please visit buildingthefutureshow.com.
Welcome back to the show. Today we have Scott Kupor. He's a managing partner at Andreessen Horowitz. Scott, welcome to the show.
Great. Thanks for having me. Great to be here.
Yeah, I'm really excited to have you on the show. I think basically anybody that's been in technology has heard of you and the firm. But maybe before we get into that, let's get to know you a little bit better and start off with where you grew up.
Sure. I grew up in Houston, Texas, actually. So
okay, very cool.
And my family is still there. And for people who know me around here, you'll see me wearing cowboy boots most of the time as a little bit of a tip to my heritage.
That's awesome. So you went to university. What did you take and why?
Yeah, I went to Stanford.
Okay.
And I was actually a public policy major at Stanford, which is kind of like, you know, some economics and some political science. It's kind of a mixture of a bunch of stuff. Why I did it, I think mostly I was kind of just looking for something that was, quite frankly, intellectually interesting. And I was, as much as I kind of liked math and science, I was pretty sure from a career perspective that that wasn't the direction I was going. So this seemed like, you know, the next best alternative, I guess.
No, very cool. And you got your law degree as well, correct?
I did, yeah, at Stanford as well.
So what made you decide to go into law after?
I went to law school thinking I wanted to be a lawyer.
Okay.
That was kind of my intention. And but like a lot of people who go to law school, I hadn't actually ever worked as a lawyer before, or didn't really, quite frankly, even understand what the job of a lawyer was.
Gotcha.
And I always thought kind of, you know, business transaction stuff was interesting.
Sure.
And but what I found was I was more interested in the business side of the business transactions than the legal side. And so that was why I kind of, despite the fact that I went to law school, I ended up actually, you know, taking a different turn from a career perspective.
Sure. So walk us through your career up until Andreessen Horowitz, maybe some career highlights along the way, because you've done a ton of stuff.
Sure, absolutely. So I started out here in 96, 97, which was kind of the beginning of what turned out to be the tech bubble that we all know and love from 99, 2000. And I initially worked in the investment banking industry. So what that meant was I was taking companies public. I was helping companies make acquisitions. And as I talk a little bit about in the book, many of the names of the companies that I took public, unfortunately, probably you have not heard of, because many of them had incredibly strong rises up and then, you know, some spectacular failures on the downside of the dot-com bubble. But through that experience, I got introduced to Marc Andreessen and Ben Horowitz when they were starting a company called LoudCloud in 1999. And it turned out that actually a friend of mine who was at a company whose company I had taken public, he quit after the IPO of his company to join Marc and Ben in this company called LoudCloud. And at the time, LoudCloud was basically trying to build Amazon Web Services, what that is today. So we had this idea that, you know, compute could just be a utility, and you didn't have to worry about your database. You didn't have to worry about networking. You could just write your code and magically plop it onto, you know, kind of a system, and it would just run beautifully. And like a lot of things in venture capital, and I talk also about this a little bit in the book, you know, kind of it was a great idea that was probably a little bit before its time. And so it's funny now to see, obviously, the tremendous success of Amazon Web Services, but also, quite frankly, lots of other ideas that didn't work in 99, 2000, but that are now working as companies. And so sometimes, you know, timing actually does matter in these businesses.
Sure. So go ahead.
Then,
sorry. Keep going.
Go ahead. Sorry. Yeah. So anyway, I was at this company, LoudCloud Opsware, for a long time. We eventually sold that company to Hewlett Packard in 2007.
Very cool.
And you know, after that, what was happening was Marc and Ben did a bunch of angel investing on their own. And in 2008, they approached me and said, "Hey, this angel investing is a lot of fun, but we think we can have a bigger impact on the startup ecosystem if we institutionalize this and go raise a traditional fund, you know, from regular institutional investors." And so I was lucky enough to be employee number one and, have been here for 10 years since.
Wow. That's very cool. So I think at this point, everybody's heard of you guys, but do you maybe just want to give a little bit of a quick overview of what Andreessen Horowitz does and who you guys are? And then I want to get right into the book.
Absolutely. Yeah. So we are a venture capital firm, which basically means we invest money in very early companies. Sometimes those companies literally are just a couple people who have an idea and haven't built anything yet.
Very cool.
And we work with those companies sometimes over 5, 7, 10, 12 years. And, we hope that some of them grow and turn into a Facebook or a Twitter or an Airbnb, companies of kind of that scale and magnitude. So that's what we do. We mostly invest around a software theme, meaning that kind of anything where software is really the core technology for the business, we are interested in looking at. And then we take a little bit of a different approach to the business in that we believe very strongly in working closely with and helping our companies as they grow and scale. And so unlike most venture firms, we have a big team here. So we have over 150 people today.
Wow.
And about 2/3 of those people are actually on the post-investment side who are working on a daily basis with our companies, helping them acquire customers, helping them do PR and marketing, helping them kind of identify great executives or engineers to hire. And so the whole kind of MO of our business is, that capital is obviously a great thing, but capital is kind of a commodity these days. And so we believe to be competitive in this market, you have to offer something other than capital to people. And that's what we intend to do through our team here.
Sure. And most VC firms don't even come close to offering that range of services to their investments. Is that fair to say?
That is fair. Yeah. I think, we've kind of designed, definitely a new model. And there are, people who are doing a few things at the margin that are, kind of in the same space that we're doing, but nobody's got the scale of people and nobody's really built it into the DNA of the firm in the way that we have from the very beginning.
No, that makes total sense. So what made you decide to write the book, and what's the book called and about?
Sure. The book is called Secrets of Sand Hill Road, Venture Capital and How to Get It. And I wrote the book because I've been in the tech business for about 25 years now. And as we talked about, both as kind of initially, a financier, a banker, and then as an operator, and then for the last 10 years in the venture capital side. And I just felt like there are so many things that I learned over time and so many nuances of the business that I thought could be helpful to anyone, whether you're an entrepreneur or you're in a startup company, or quite frankly, you just want to know, how does technology work and how does it impact the overall U.S. economy? And so I just felt like putting it all down in words and hopefully offering that to that set of folks was would be valuable to a lot of people in thinking about whether venture was a good place for them to be, or startups, or just kind of who wanted to learn how the business worked.
No, I think that makes a lot of sense. And like I told you before we started recording, I've actually, you guys were nice enough to send me a pre-release copy, and I read the thing. And the one thing, there's a number of things that I took out of it, but the one thing that really fascinated me about the thing is, sure, you cover from beginning to end of why you raise VC money, or maybe you don't want VC money, and everything up until selling your company or taking it to an IPO. But what it really did for me anyways is it got me thinking about just the whole thing, and not only what the VCs and you guys are thinking about as you're investing, but from the mindset of either the people working at a company and or the upper, management, the CEO, those types of people, because I've been an employee, I've been in the C-suite, and it's interesting just to think about what other people are struggling with, right? And maybe you're not the direct person actually raising the capital, but reading this book, I was like, oh, I never thought of it like that as like the CEO, or I never thought of that from what the VC's thinking about, right? And that was the one big takeaway for me that I found. I was just like, it really got me thinking about the whole space, and it was really kind of eye-opening. Obviously, I thought I understood it at least pretty decent. I learned a ton, and you covered where sometimes I've read these books and they get so complicated so fast that your eyes gloss over and you kind of just like, what is happening? I don't know what I'm reading. And I found it to be entertaining, and it was really simple to understand the different stages and working through the journey.
Well, well, first of all, thank you. I mean, obviously, I'm thrilled that you enjoyed it, and I'm glad. I'm really glad that you described it that way, because that's really what I wanted to do. I think that the challenge in this business is, for a long time, it's been a black box to a lot of people,
Sure.
right? It's kind of like, there just nobody really understood how it worked, and it's kind of got lure to it, but there's not a whole lot of information out there. And part of my objective was, I think, if we can kind of demystify it and help people understand it better, quite frankly, maybe that encourages more people to start companies. It encourages more people to join startups. And so, I hope that if the ideas of, if we can democratize access to information, we might, quite frankly, also better democratize access to entrepreneurship, which, is something that I think, this country really needs.
Yeah, no, totally. And it's interesting when, to me, you broke it down, basically talking about the pros and cons of VC. So do you maybe want to dive a little bit deeper into that concept, why people should raise VC or maybe not raise VC money?
Yeah, that's a great point. I think we talk about this a lot in the book, but I think the way to think about this is, venture capital is not necessarily, kind of the perfect, source of financing for every company. The way we think about it is, are you trying to build a company that can be, a Facebook or a Twitter or, Airbnb over time? And what we mean by that is your objective to build a very big and a very enduring and, ultimately a very kind of, successful business? And if so, and that business also requires capital. So I'll give you an example. We're an investor in Lyft, as you know, which
Right.
recently went public. The reason for Lyft to raise capital from venture capitalists was because, number one, they had a vision to build something that could be very big and ultimately a public company, and they've done a great job achieving that. But then also they needed, obviously, capital to do that. I mean, it's an expensive business to go be in all kinds of cities and acquire customers and acquire drivers. And so if you're in a business like that where, kind of it takes, essentially risk capital in order to be able to achieve the business objectives, but it's obviously highly risky. I mean, Lyft, could have turned out, like a lot of companies, they could not have ultimately succeeded if they hadn't executed as well as they had. And that's really kind of the way to think about the sweet spot for venture capital is, kind of, does it have high risk, high capital intensivity, and, is there an alignment of objectives, right? So I think where people sometimes, get it wrong is, if your goal is to build, maybe a very nice business, but something that's relatively small in terms of the total size it can get to, that could be a fantastic opportunity, but probably raising venture capital for that is not a great idea, because you're probably misaligned with the objectives and the incentives of your venture capitalists, because they're going to want to push you, obviously, to build something that's, kind of bigger and more broadly applicable to folks. So I think that's the first question that people just need to ask themselves is, kind of, am I, a candidate for this? And then once they do that, then what I hope the book helps them understand is, okay, if you take the money, what does that mean, right? How do you work with a venture capitalist? How do you think about valuation? How do you think about, even, kind of all the aspects of a term sheet that are relevant? Those are the things that I hope, we've done a good job explaining to people.
No, I think you did. The other thing that I think is very much related to what we just talked about that you cover in depth is where VCs actually get their money from and the life cycle of that money. Do you want to explain that and dive a bit deeper into that? Because I found that to be one of the most fascinating parts of the book, because I think a lot of people don't think about that.
Yeah, that's great. I'm glad you like that. Yeah, we as you mentioned, there's a whole chapter on this, and I use the example of Yale University in the book, because Yale is one of the oldest and quite frankly one of the most respected investors in venture capital. And firms like Yale or other educational institutions, right, they have to basically help support the educational mission of the university. So, hopefully their alumni give them money, they donate money, and then Yale's job is to earn, as high a return on that money as they can, so that then every year they can basically take some of that money and give it to the university to pay for employee salaries or for tuition or all kinds of things that have to happen. And so, universities like Yale look to venture capital as, kind of a very potentially high returning asset class, right? Because they could invest in public markets or they could invest in bonds, and all those obviously have some kind of return profile. But venture is the segment of their investments where they're really trying to generate very high returns. And that means, something like maybe 25 or 30% kind of, compounded, IRRs, which, is pretty serious kind of, challenge to get to. And so the reason I wrote about this is if you understand that, then you understand the incentives and the motivations of the venture capitalists, which is right. My job is to generate a very high return for Yale University or for a big foundation like the Packard Foundation or the Hewlett Foundation. And so that then creates the incentives for me as a venture capitalist to want to create and need to be able to generate some very, very large companies that can ultimately be very valuable as standalone businesses. And so again, I think it's a lot of what I think we tried to articulate in the book is you're right, which is you have to understand the life cycle in order to understand how that incents behavior. And then you as an entrepreneur or as an employee in a startup company, can get the benefit of understanding why people may do things based on the incentive structures that they're paying attention to.
Yeah, and it was also interesting when you talk about if a fund's at closer to the end of the life cycle, potentially worrying about not getting a second investment from that same fund, right? Where if it's earlier on, the chances are potentially a lot higher and you might not have to go to another VC firm to get money. That was kind of interesting to me that I never really thought of before. Do you want to explain that a little bit better than I just did?
Yeah, you did a great job, but sure, I'll add on to it. So in the book, what you'll see, right, is that these venture funds have, they have a life, right? So typically the life is about 10 years. And so, as you mentioned, one of the things to be mindful of when you raise money is where is the venture capitalist in that life cycle of that fund? Because they may be investing in the first round of your financing today, let's call it the Series A, right? The first financing. But presumably, if you're successful, and sometimes even if you're not successful, you will need and want to raise more capital over the next 2, 4, 6, 8 years. And so one thing to be mindful of is, where is the VC in their fund life cycle? Because if they're investing in you and they're already in year 6 or 7 of the fund, then when you need more money, they may already have exhausted all of that capital in that fund. And that means either that you need to go to other venture firms or you need to assume that this venture capitalist will be able to raise another fund and be able to fund you out of that. And so it's important as an entrepreneur to at least kind of understand, again, the nature of how these things could impact your downstream funding and just be mindful of some of those aspects that are kind of a little bit inside baseball for the venture capital firm, but can have big implications for you as an entrepreneur.
No, I think that's really great advice. So how do people, or how do you guys expect people to pitch to you guys? Are you looking for phone calls, emails? How do people actually get in front of somebody at Andreessen Horowitz?
Yeah, so most of what we do tends to come in from some type of referral. So there are some things where people will just kind of, cold email us, and that's great. But I would say, kind of advice I would give to entrepreneurs is really work your network and figure out, okay, can I at least get some kind of warm introduction to somebody in the firm? And it doesn't need to be, somebody's best friend, but at least some way to kind of, get through a referral as opposed to a cold email. And in some respects, actually, it's a good kind of test of your mettle as an entrepreneur, which is it's a good show of your ability to be creative and persistent and, kind of work your network in a positive way to be able to get in. So that's typically how it happens. And then, we will, sit down. We really prefer doing face-to-face meetings with people. We talk about this in the book a lot about the importance of team, for example, and why team is so important in the evaluation process. And it's a lot better to be able to evaluate the team, obviously, face-to-face and spend time with people. And so a lot of the interactions tend to happen that way, through, these pitch meetings.
No, that makes total sense. So you covered something that I think a lot of people take for granted in their pitch decks is educating the VC or their investor or really anybody on the actual size of the market. I think a lot of times people don't fully explain how potentially big the market size is. And it sounds like you would agree with that because you wrote a bunch about it in the book.
Yeah, I would agree about it because number one, it's a really important part of the evaluation process, and it's a hard thing sometimes. So let me give you an example.
Sure.
If you when we were looking at Lyft, for example, right? Okay. I mean, a lot of the way people evaluated the size of the market is they said, okay, well, we know that there's a taxi market. We know taxis do some amount of money. In fact, I heard the other day an anecdote. I don't know if these numbers are exactly right, but they're probably directionally right. That at the time when Lyft was raising money, the total amount of revenue in the San Francisco taxi cab market was under $100 million. Okay, so that meant, for all the receipts the entire year, it generated $100 million. I think today between Lyft and Uber, they do collectively about $1.5 billion in San Francisco. So,
wow.
And that's just in one city, right? And so it's a good illustration of where if somebody were kind of stuck in this kind of mantra of the taxi market is really the way to estimate market size, you would have vastly underestimated the potential. And that might have caused you, quite frankly, to not want to invest in Lyft because you might have thought, hey, it just can't be that big ever. But it's a challenge. And this is why I say I think it's part of the entrepreneur's job to help the VCs understand that, because particularly in a thing like Lyft, you had to conceive of this idea that the presence of, an application on a mobile phone that everybody's carrying around could actually increase the size of the available market. And, you might have intuitively thought about that, but it took somebody like, the founding team there, John and Logan, to really articulate that to us and help us understand their vision for why, kind of ubiquity of cell phones could actually create a market that was just vastly different in size than what, kind of a comparable taxi market could have looked like. So I think it's a real important thing and something really that the entrepreneurs need to help the VCs kind of think through so that we can really understand the vision and the expansiveness of their thinking.
Oh, I think that's really good advice. So I'm curious, though, what other advice, or is there any myths or things people should or shouldn't do when putting together a pitch deck or pitching to you guys?
Sure. Yeah, there's a couple things I'd point out. And again, you'll see in the book, there's as you've seen, there's a whole section on this.
Yeah.
But a couple things. I think one is, again, as I mentioned, understanding how venture capitalists evaluate deals, I think, is important to knowing how you want to pitch the deal. And one of the biggest, areas of evaluation is team. And that may sound obvious, but I will tell you, a lot of entrepreneurs, quite frankly, don't spend very much time on the team.
Right.
And what we're really trying to assess is, let's assume the market is big, which means it's probably going to be really competitive. And so the real question we're trying to figure out is, why would we invest in this team that's currently pitching versus any other team that might come along with a similar idea? And the kinds of things we're trying to look at, I'll give you, maybe it's easiest by way of an example. We're an investor in a company called Tanium that you may have heard of, which is an enterprise security company. And the founder there, Orion, and his father actually is his co-founder, David, they had started a security company about 15 years ago called BigFix, which was really in the same space, the endpoint security market. And Tanium really is kind of, the updated version 2.0 of that company. And when we kind of had the team discussion in our pitch meeting evaluation, we said, okay, we believe this is a big market, right? So endpoint security is pretty big. And could we conceive of another team that has the level of domain expertise or kind of the background in this area that could execute on that market better than David and Orion? And that was really, 90% of our evaluation at that point in time was really kind of the kind of incredible fit between the background of this team and the opportunity they were prosecuting. Those are the kinds of things we're trying to assess. Sometimes we're assessing, leadership capabilities, but it's so much around those qualitative nature of what is it that what is the secret that you've earned that's different than someone else who might not have had that experience knows, that, really puts you in the catbird seat in terms of being able to actually, kind of go after a great opportunity.
No, it makes a lot of sense. So you guys invest in, say, my company. How do you guys work with me and my startup? Because you kind of covered it at the beginning, but I really want to dive a lot deeper into that because I think it's very, very useful and valuable.
Absolutely. So the way it works is we have a series of teams. We actually have 5 separate teams today, and they cover areas like, sales and business development, PR and marketing, talent. So helping, identify and recruit great executives as well as great engineers. And the way we work is when we first start working with a company, we do what's called an onboarding meeting with them. And we sit around the table with hopefully the whole executive team from the company. And we say, hey, look, tell us about what are the things you're focused on for the next 6 or 12 months? Tell us about engineering, tell us about marketing, tell us about sales, whatever are the key goals. And then we try to kind of identify where are the places that we can plug our resources into to help improve the chances of the company being able to achieve those goals and hopefully, even exceed them. And importantly, we recognize and we're very, very conscious of the fact that we are venture capitalists and that, we are not the ones building these companies. The entrepreneurs are doing the hard day-to-day work. And so we've got to be really careful to not, forget about that and overstep. So we're not going to ever go in and perform a function for a company. We're not going to ever go in and actually like be an interim manager in a company because we recognize that kind of the magic of what we're investing in is the entrepreneurial spirit that's in that company. And the last thing we'd ever want to do is kind of interfere with that. But our hope is that we can kind of show people with the resources and the relationships and networks we have that we can really help them identify new customer opportunities and other ways to help them grow the company most effectively.
No, I that makes a lot of sense. So the thing that you covered a lot in the book that I also found really fascinating was the whole how it used to take companies 4-ish so years to go either maybe get sold or IPO. Right. Now it's taking about a decade. And then the vesting side of that as well. Do you maybe want to dive into that a little bit deeper?
Sure. Yeah. This is a very interesting topic. So I'll try to kind of see if I can explain it in a few words.
Sure.
But as you described, right, oftentimes if you look at the history of venture capital, which goes back kind of, roughly 40 years in the US at least, it usually took about 6.5 years from the start of a company to going public.
Right.
And as part of that, as you and your listeners probably know, many people in these companies get equity compensation. So they get options in the company that, represent a portion of the equity in the company. And those options vest over time, meaning that, I may give you 100 shares of options today, but over a 4-year period, you will kind of, ratably vest them over that time period. And the whole idea there, of course, is you're trying to create a long-term economic incentive for the employee to kind of remain and be productive at the company. And that 4-year time period made a lot of sense when companies were going public, call it 6.5 years, because, you don't hire everybody, of course, on day one. But that would mean for many employees, by the time they were fully vested with their shares, that the company would be public, and therefore there would be a public market that they could sell those shares into. One of the challenges that we have today in the industry is companies are staying private a lot longer, as you mentioned. So typically, kind of 10 plus years. And so what that means is a lot of employees will vest their shares, but those shares will not be publicly traded, and so they won't be able to sell them in the way that they used to. And so it's a real challenge for companies because they clearly want employees to be able to enjoy the appreciation of the equity options they've had, but it does kind of require us to kind of rethink about what's the appropriate time frame in some cases for options, and are there other creative things that companies need to do to help allow employees to be able to kind of enjoy the benefits of equity, but potentially not have to wait 5, 6, 7, 8 years before they can actually sell those shares in the public market. So it's a real issue, and one that the industry, both on the venture side and quite frankly on the company side, is struggling to figure out how best do you kind of incent employees given the time periods are just dramatically different than they originally were.
No, I think that's interesting, and then let's cover the flip side of that, because obviously when somebody like Andreessen Horowitz puts money into your company, you guys are getting a certain percentage. And how do you guys balance the percentage you're getting with the vesting of employees, plus, obviously getting more, you want to up the share value and then people get diluted, and you cover it really well in the book. So do you want to talk about all that? Because it's quite interesting how that all plays out.
All right, I'm going to try. You're hitting on some really fun topics, but these might not
well,
do
it's
well
all in the book. People go read longer about them in the book.
That's right, exactly. So yes, right. If you don't follow what I'm saying, just pick up the book. So thank you. Yeah. So yeah, when we, as you said, look, when we invest in a company, we end up owning some percentage of the company. So let's just say 25%, which is often at the early stage. That's a reasonable percentage for a company to sell and for a venture capitalist to own. And then what happens over time is there's 2 ways you can get diluted, right? Which is basically is a fancy way of saying your ownership interest goes down. One is, as you said, is over time, as the company hires more employees, they will want to give those employees options. And so those options can't come out of thin air, right? They have to come from the company. And so when the company issues more options, that means, kind of I now own slightly less of the company than I did before, right? Because the number of shares is growing, your denominator is growing. And then, as you also, I think, alluded to, the second way that dilution happens is when the company raises more money, because again, the mechanism of raising more money is somebody puts money in, and in exchange for that money, they get shares. And again, those shares, don't get created out of thin air. They actually have to come from, that same pool of the shares. And so therefore, again, kind of I now own less of the company. The way the venture capitalists try to protect themselves on that is often we will reserve money when we make an initial investment in order to invest some money in a later round of the company. And so if we own 25% of the company, for example, and we think the company is going to raise money down the line, we might, hold back on our own books enough money so that, at the next round of financing, we can invest more dollars in order to be able to kind of maintain our percentage ownership. And so that's the way the venture capitalists try and protect themselves. Obviously, for employees, it's a harder thing for them to do. The hope over time for employees is for people who are doing well, the company will often give them another set of options. They'll do what's called a refresher set of options to hopefully help them kind of get more ownership in the company over time, even as obviously, the company itself, is continuing to have some dilution from this additional investment. And so there's this constant, kind of, yin and yang, I guess. And, it all works out fine as long as the value of the company keeps going up because, of course, I'd rather own 20% of a company that's doing great than 25% of zero because 25% of zero is still zero. And so nobody really worries about a lot of these things, obviously, when everything's going up nicely, up and to the right. But, these are the things that can become more challenging as companies mature and potentially aren't growing at the same pace they were or aren't achieving the same objectives that, they had intended. And that's where, sometimes, things can get a little bit more challenging.
No, I think that makes a lot of sense. The other thing that I found really interesting that you cover quite a bit in the book is the different roles of from your guys' side on the investment side and the people inside the company, and then creating a board at the different stages of the companies. Do you want to maybe elaborate a little bit on that?
Yeah. There's a lot in the book on board, kind of what's the role of the board, and kind of I have a little bit of a section on kind of good board member, bad board member.
Yeah.
And I think the most important point, to recognize, and sometimes, unfortunately, I think venture capitalists get this wrong, is that, no matter how smart you are, no matter how involved you are as a board member, there's just no way you understand the company at the level of depth that somebody who is inside the company does. And so I think where boards can go wrong is they believe, based upon talking to the CEO or reading a board deck, that they know more about kind of the state of the company or the capabilities of the business. And, sometimes, unfortunately, boards overstep their bounds and, offer advice that just doesn't resonate or doesn't take into account lots of things they just don't know about how the business is working. And so the best functioning boards are those that recognize that their main job is to provide kind of, high level guidance and counseling to the CEO. And of course, boards have the ultimate authority to either, to add or remove a CEO. And if the board really feels like, the company isn't doing what it needs to be doing, the mechanism by which they do that should be to kind of have that conversation with the CEO. And if that behavior doesn't change, to potentially think about changing the CEO. But it's really the wrong behavior to kind of overstep the CEO and try and kind of get too entangled in the day-to-day of the business. I've never seen that go well. It's always an incredible failure case for the company. And quite frankly, it's really unfair to the entrepreneur because it really undermines the entrepreneur, in front of their employees. And so much better for the board to kind of have the hard conversation with the CEO about whether, the things, he or she is doing are appropriate for the business and can continue that way versus, overstepping their bounds.
No, I think that makes a lot of sense. So I want to cover the sale and the IPO of a company. Do you want to give a little bit of overview of what you talk about in the book on both of those ending of a company?
Sure. Yeah. So when we make an investment in a company, as I mentioned earlier, we really are, believing at the time that this company can go public, can have an IPO, because that means that the company has grown to the scale that, we all aspire for it to, and it's become very valuable and is doing a really important role in the ecosystem. Now, the reality of the business, unfortunately, is that most companies don't get there. Obviously, a lot of our companies just don't succeed at all, unfortunately. But for the ones that succeed, still the vast majority, probably 80% of them end up getting sold or acquired by companies, and about 20% of them go public. And so, there are very different, things to think about, right? Oftentimes you sell a company because either maybe the market size wasn't as big as you thought it was, and so therefore the kind of economics of the business just don't work as well, or maybe the product, has changed over time and you're no longer kind of competitive. those are often, good reasons why companies do sell to another company, is because maybe the business can actually survive and thrive better as part of a bigger organization that is a standalone company. And then sometimes, of course, there are just companies that operationally just don't execute well, even in a good market with a good product. And in those cases, if you can't kind of find a way to bring a new team into the company that can, address that execution, you might find that, exiting through an acquisition makes sense. But the ultimate goal for most of these companies is to try to become public companies, because that allows them obviously to continue to be enduring and deliver, the value they've been delivering to customers, albeit in a much bigger scale. And that's, we're now, as you've probably seen if you're reading the news lately, for a long time, we didn't have a lot of IPOs in the tech industry, and we're still kind of pretty far below historical standards. But at least this year so far, we've had, a decent number of IPOs, and looks like we're on track, hopefully, to end the year, kind of probably around 50 or so, VC-backed technology IPOs, which is, again, by historical standards, quite frankly, still a small number, but at least, improving relative to where it's been for the last 3 to 5 years.
No, I think that makes a lot of sense. And it's actually quite fascinating how the landscape is changing. And that was actually going to be kind of my next question to you is, how do you see the landscape change in the last 10 years? And where do you think it will potentially go? Because you talk a bit about it in the book, and it was kind of interesting on the crowdfunding side and other things. Yeah.
So I'd say the biggest change over the last 10 years has been kind of the emergence of the institutional seed market. And what I mean by that, just so everyone understands, is, for a long time we had these things called angels, right? And I think we mentioned them at the beginning of the conversation. And angels were and are individuals who are typically investing their own money. They might be writing a $15,000 check or a $100,000 check, but it's typically on behalf of themselves. And what happened over the last 10 years is seed as an actual institutional category, meaning where there are firms that raise kind of traditional institutional capital like other venture firms, has grown tremendously. And that's really changed the landscape for the business here, because it really has meant that, kind of whereas before, a Series A venture capitalist might have been the first one to put institutional money into a company, there's now a whole set of seed firms kind of upstream of those firms today that are in the company first. And that changes how you think about competitive dynamics in the industry, and has made it, a very competitive market, and, I think very, very good for entrepreneurs in terms of available capital. The other big thing that's changed, which we just alluded to also over the last 10 to 15 years, has been this concept of companies staying private a lot longer. And what that means, among other things, is that there's an opportunity in the private markets to kind of raise funding at lots of different stages that just didn't exist before. And, and a lot of the appreciation in companies now is happening in private markets versus public markets. There's a great anecdote that I always like to use here, which is when Microsoft went public, they were valued at about a $350 million market cap, which is hard to imagine anymore. I think just literally the other day, it crossed $1 trillion in market cap. So, if you do the quick math, I think that's like 3,000x of a return in Microsoft from when they went public to today. Facebook, on the other hand, went public at $100 billion and has done incredibly well, and is valued, I think, at like $500 or $550 billion. So, it's grown very well in the public markets, but certainly a much smaller multiple. If you do the math and you kind of assumed that Facebook, could achieve that same 3,000x increase in the public markets as Microsoft has done, Facebook would be worth more than the entire global GDP. Wow. So it's obviously that's probably not going to happen as much as you might like that if you're a Facebook shareholder. Sure. But the point of the illustration is that kind of more and more of the appreciation of these companies is happening in the private markets relative to the public markets. And so, as to your question, I think what that means, kind of fast forwarding for the next 5 or 10 years, is I think you will continue to see more capital come into the private markets in order to kind of, be able to capture some of this appreciation. We already see that from, some players like SoftBank, and even some, big, kind of sovereign wealth funds, and for various other players. So I think the private markets are going to continue to expand as a very, very significant source of capital for lots of these companies over the next 10 years. And, I think that's a good thing for entrepreneurship. It's a good thing for new company formation. It's probably not as good of a thing for the public markets, in the sense that, for people who can only invest in the public markets, they probably are not going to have the same level of growth and appreciation that you might, expect to find in the private markets.
No, that makes a lot of sense. It's interesting. So I'm curious, you cover in the book about building relationships with potential people and acquirers before you're even really thinking
Yeah.
of selling, and some of those could potentially be your competitors. Do you want to elaborate on that?
Yeah, I think I used the analogy, which maybe is not a great analogy in the book, but that, kind of you always want to, you may not want to go to the dance, but you want to get invited at least, right? That's kind of always your goal,
Sure.
whether you're in high school or quite frankly, whether you're a startup company. And so I think about it in that context, which is if you're a company, it's always good, your goal may not be to be acquired and you hope, you can grow into a public company. But, it's probably good to know who the potential acquirers are and figure out, are there ways where you can start to build relationships with them? And so sometimes that can just be, it could be as simple as literally a personal relationship. Other times, maybe there's business development opportunities that you can do together as a way to get to know each other. But, all those things kind of, at least, give you visibility to what some of those potential companies are doing. And, to the extent that you decide you want to sell the company, or maybe it financially will make sense for you to sell the company. You want to kind of have those relationships started. There's an old saying in the acquisition world. I don't know who said it, but which is companies basically get bought, not sold. And what that means is kind of you want that organic pull of other companies who kind of want to buy you, as opposed to you trying to market yourself and sell yourself to a company. Obviously, that's a much less favorable place to be. And so I view this whole concept of relationship building and kind of early, relationship development as a way for you to kind of build those relationships that ultimately might enable you to get bought, not sold, if that's the right course to go. And, I think you can do that in a way where you don't compromise your technology and you don't have to give them access to proprietary information, but you can find ways to work together that at least make sure that, if that dance is happening, you're on the receiving end of the invitation.
Sure. Well, and you could potentially send each other business for a while before one of you actually picks up the other one, right?
Absolutely right. Exactly right. Exactly. It's I don't want to strain the analogy too much, but dating before you get married turns out to actually be a good thing, right?
Yeah. No, fair enough. So I'm curious to get your thoughts on, and I'm sure you probably get asked this all the time, but selfishly, I'm really curious about it. Do you think we're in another bubble?
Yeah, so I've actually written a lot about this. Not just there's a little bit in the book, but also I've written a lot, kind of in our blog on this.
Yeah.
The quick answer is no. So and let me just give you a couple. I'll give you a few data points just so you have a sense. So in '99 and 2000, obviously, which was the height of the bubble, there were more than 700 IPOs of tech companies in those 2 years. In the 10-year period from kind of 2009 to today, there's been about 450 IPOs. So we literally have had over 10 years, barely 2/3 the number we had in 2 years. And when you look at the maturity of the companies, it's really starkly different. So for companies that went public in '99 and 2000, the revenue on average was about $17 million in annual revenue for the companies. I think if you look over the last 10 years, it's something like $170 million. So kind of 10x the maturity of the companies. And so number one, I just think it's always fun. It's always fun to make the bubble comparison. I think the reality is the numbers are very different. And then the other thing that's really different, and Mark Andreessen used to tell this story, is just the sheer market size and therefore the opportunity for these businesses to work and to work at scale. And the best example that Mark used to always talk about was when they sold Netscape to AOL. That happened in 1998, I think, was when they sold it. The total number of internet users was something, less than 100 million users, right? So that meant the entire market that Netscape could sell into was 100 million people who were on the internet. Today, obviously, we know that number is, kind of in the several billions and probably going to 5 to 7 billion over the coming years as things like Android and other low-cost operating systems, permeate beyond just the, kind of the developed world. And so when you think about that, what that puts into context, I think what we're seeing today, which is that businesses that just couldn't work in '99, 2000 because the market size was not big enough relative to the cost that it would cost to acquire those customers, lots of those things can work today. And that's why you see, for example, Instacart, which is a company in our portfolio that does, grocery delivery. A company like Instacart can work today, even though Webvan didn't work in '99, 2000. That's not because, kind of it's just inherently a bad business, but Webvan, quite frankly, never had a chance of success because there just weren't enough consumers who ultimately could, access that relative to the cost it required for them to actually be able to service those customers and acquire them. And so, this is not to say, of course, that every company is going to be successful, and there are always places where valuation sometimes can get out of whack with the fundamentals of the business. But in general, what gives us optimism about why, we don't see this as another bubble is just the sheer kind of opportunity size that exists out there. And quite frankly, the level of technological innovation that we continue to see from just tremendously, kind of smart and aggressive and, capable entrepreneurs.
No, I agree with you. I think it's important to get somebody like yourself at a really, really well-known popular company to talk about this stuff, because I think it puts a lot of people at ease, right? And I don't think people worry as much, or hopefully they don't worry as much. But we're kind of coming to the end of the show, but I really want to get kind of some final thoughts. Do you have any final advice for people out there, either on the investment side or on the startup side, or maybe a bit of both?
Yeah, look, my biggest advice is, I hope, as I mentioned at the beginning, the reason I wrote this book is because I really think that we need to democratize access to the kinds of information that, quite frankly, has been, held pretty tightly in the past. And I hope that by doing so, that encourages more people to think about entrepreneurship and think about the role of technology in our society. And so I guess my biggest advice would be, hopefully people, see the book as an educational opportunity, and that then creates, new and interesting economic opportunities for people. And then, I'd say the other biggest piece of advice is, really understanding, just like in any part of business, part of what I wanted to kind of explain here is, if you're going to take money from venture capitalists or you're going to start a company, you have to understand, what makes those individuals tick and what incentives they have. And I think that makes you a better entrepreneur, and it'll make you, better adept at the capital raising process. And so my best advice is kind of, understand who it is that you're thinking about partnering with, what they bring to the table, what you're looking for them to bring to the table, and, approach it in the same way you would any other relationship, which is, kind of build that relationship over time and really kind of, take to heart what it is that you think the value is that venture capitalist can bring to your business.
No, I think that's great. And just to reiterate, I said this kind of at the beginning of the show, I've been on the design side my whole career, basically. And I obviously don't come from a financial background, and I very much understood everything that you covered in the book. I think you simplified it. But I think part of the problem with some of these books is people are like, well, I'm not the CEO, or I'm not the chief financial officer, so I'm not going to read that. But like I said earlier, is somebody... Obviously, I'm not those people, but understanding where those people are, what they're dealing with, or understanding where you guys are coming from on the investment side, and then also understanding where the company I'm either working for or a partner of is going based on how we got financed, right? Whether we're bootstrapping or whether we're a venture fund or somewhere in the middle, right? And sometimes you're bootstrapped at the beginning and then you take venture fund. And so for me, just understanding the life cycle of being at a company for 5-10 years before it potentially gets acquired and or goes public was really useful for me even, right? And so I just kind of want to reiterate that, because I found it, like I said, a number of times, really a really great read.
Well, I appreciate that. I sent a preview copy of the book to my parents.
Okay.
And when my mom sent me a note back and she said, I understood 75% of what you said, I felt like I felt pretty good. I felt like I had accomplished the goal of truly demystifying venture capital.
No, that's very cool. But we're at the end of the show, so how about we close with mentioning where people can get more information about Andreessen Horowitz, the book, and any other links you want to mention?
Absolutely, yeah. So Andreessen Horowitz, we are just at a16z.com. That's a16z.com, and you'll see all kinds of content there. You'll see blog posts, videos, all kinds of great stuff.
Podcast.
The book, as you mentioned, is called podcast. Yes, podcast. Of course, I apologize, I forgot. The book is called Secrets of Sand Hill Road. You can actually pre-order it today on Amazon. So if you go search on Amazon, you'll find it there. And the release is on June 4th. But if you want to make sure you get your copy first, pre-order today. And then you can follow me on Twitter at SKUPOR on Twitter as well. So hopefully between one of those three sources, we can get some content that's relevant for what you're looking for.
Perfect, Scott. Well, I really appreciate you taking the time out of your very busy day to be on the show, and I look forward to keeping in touch with you, and have a good rest of your day.
Thanks, Kevin, for the time. Bye-bye.
Thank you. Bye.
Thanks for listening. Please visit our website at buildingthefutureshow.com to join the free community, sign up for our newsletter, or to sponsor the show. The music is done by Electric Mantra. You can check him out at electricmantra.com and keep building the future.